Hello, and thank you for joining us today. We're diving into a critical topic for investors: how macroeconomic shocks like trade tariffs can influence equity portfolios and what they mean for navigating an increasingly complex global landscape. We'll explore how MSCI's tools like stress testing and economic exposure data can help support investors in building more resilient portfolios, especially in uncertain geopolitical and economic environments. Joining us now from MSCI to share their insights on these topics, along with practical takeaways that may help investors prepare their portfolios for uncertainty, we have Abhishek Gupta, Executive Director of Equity Investing Research, and Thomas Verbraken, Executive Director of Analytics Research. Well, it's great to have both of you with us today. Starting with you here, Abhishek, how can trade tariffs serve as a significant stress event for equity portfolios, and why should investors model their potential impact?
Trade tariffs can create significant stress for equity portfolios because they introduce uncertainty in corporate revenues, they can disrupt global supply chain of companies, and they can potentially trigger macroeconomic impacts such as higher inflation, slower growth, or even recessionary conditions, as we are seeing today. When tariffs are imposed, companies that are heavily reliant on international trade, they can see that the cost of their goods have increased. They can potentially experience compression of their profit margins, or they can even see, erosion of their competitive positions, which of course can ultimately affect their share prices. Now, this is something that investors need to be absolutely cognizant about. Investors need to model these potential impacts to understand how portfolios could respond under different tariff scenarios. By using stress testing tools such as factor models or revenue exposures of companies, they can potentially pinpoint the vulnerabilities within their portfolios, which would be more of a direct effect, but they could also study some of the indirect effects through industry and geographic correlations. I would say that especially now, when the trade policy has become such a central part of geopolitical dynamics, incorporating trade-related scenarios into the investment process is not just prudent anymore; it's almost absolutely essential.
Now, sticking with you, Abhishek, what insights can you share on how markets have behaved this year and since the tariff announcements on April 2nd?
Absolutely. Markets have been in an absolute turmoil over the last 3 days since the tariff announcement. Global equities, represented by, let's say, MSCI Acqui IMI, that's been down over 10%. While the headlines have focused a lot on tariffs, our initial analysis suggests that the broader market reaction was actually more about rising recession fears. The risk of behavior was quite evident across the market, industry, and style factors. So defensive industries such as healthcare and telecom, they have held up because they typically tend to do well during periods of market turmoil. But energy and materials, which are more cyclical in nature, they have led the losses. If you look at styles, beta, liquidity, and volatility, they have all seen pronounced declines. Interestingly, the industries that are actually most exposed to tariffs because of a higher share of their revenues earned in international markets, industries such as autos, semiconductors, and consumer durables, they were less affected. This could potentially be because tariff risk was priced into some of these industries towards the beginning of this year. But a very interesting signal that we found was through the revenue exposures of companies and how that impacted stock specific returns. So, what we found was that companies that have higher revenue exposure to the US, they saw steeper price declines, declines that cannot be explained by existing factors within our risk models. So, this essentially underscores that investors are now tracking geographic revenue sources to gauge tariff vulnerability.
Now, turning to you, Thomas, what is stress testing and investing, and how does it help investors prepare for unexpected market disruptions?
Stress testing is about thinking through potential scenarios that can play out and how that could impact portfolios. And that's, by the way, not only useful for risk managers, but also for portfolio managers who want to understand how their positioning may be impacted under certain events. Needless to say that scenario analysis becomes critical in volatile times like these. So tariffs can have far-reaching implications for the economy as a whole and for the industries that may be hit hardest. And scenario analysis offers a framework that translates scenario narratives into portfolio implications. Now, to make this a bit more concrete, let's take the analysis we ran together with Abhishek and elaborate what we did there. The story is, of course, about the implementation of tariffs as proposed on Liberation Day, but we need to translate that story or that narrative into concrete and quantitative assumptions. And for that, we used economic exposure to identify which industries in which countries could be most exposed to tariff risk. We combined that with an analysis of recent history. Tariff concerns have been around for a while, and recent history adds some color on how industries have reacted to earlier tariff news. And that gives us a quantitative definition of the narrative, a parsimonious set of risk factor shocks. For example, in our scenario, European pharmaceutical, Canadian consumer staples, and Japanese automobile stocks are a few of the industries that take a hit. And we overlaid that with an impact to the broad equity market. Now, these are just a handful of assumptions, and the final step is to propagate these assumptions to global equity portfolios using our factor model. And this helps understand how our main assumptions could ripple through equity markets. Now, one thing I want to note is that it's important to understand that scenario analysis is not about forecasting. It really is a what-if analysis. And often we're not interested in the most likely scenario, but in more extreme scenarios that may have a lower probability, but could move portfolios more sharply.
That's a good way of putting it. Now, Abhishek, what is economic exposure data, and is it important for understanding which companies or markets are most vulnerable to tariff-related risks?
As Thomas mentioned, economic exposure is one of the important ingredients within the scenario analysis that we have run as it relates to tariffs. The MSCI economic exposure data essentially maps company revenues to countries where these revenues are earned rather than where firms are headquartered or listed. Such a lens can essentially help investors understand which companies are exposed to specific end markets. Especially, this can be important when we are assessing export or trade related risks. The data set essentially covers about 9,000 securities across MSCI, ACWI, IMI constituents, and the revenue sources are really drawn from more than 70 plus countries. This data is particularly useful in the context of tariffs. I would say, like this is actually one of the our go-to data sets as we've used this in many research that we produced over the past couple of months. What we have found is that about 18% of the global corporate revenue is potentially exposed to US trade policy. Countries like Japan, Germany, UK, Canada, and China, they are all exposed. And some of the examples that Thomas gave in terms of the industries, you have the autos, capital goods, technology hardware, they are also most affected. The closing point I would say on this is that this level of granularity can help investors move beyond some of the headline country and sector classifications to really pinpoint those companies that are most at risk, which can of course then support better portfolio construction, stress testing, and risk management.
So, Thomas, it sounds like stress testing can reveal hidden risks or exposures that might not be obvious through traditional portfolio analysis.
That's true. So risk is often assessed through the lens of portfolio volatility or tracking error. And these offer a useful perspective on the current level of risk and the drivers of that risk. Um, the risk models underpinning these volatility estimates, they react to current circumstances and they will pick up on market turbulence, but they're still based on trailing returns. And what scenario analysis can add is a truly forward-looking view, because of course the future may sometimes look different than the past. Now, let me give give an example from a multi-asset class context to make this more concrete, the bond equity correlation. So the correlation between bond and equity returns had been negative for the first 2 decades of this century. When equity markets sold off, bonds typically rallied, offsetting those equity losses. Now in 2022, when inflation surged, this relationship between bonds and equities changed suddenly. Bonds now sold off alongside equities, reducing diversification benefits for multi-asset class investors drastically. And scenario analysis allows to capture such a regime shift and think through its implications for portfolios before risk models pick this up. Now, for the tariff-related scenario analysis, as Abhishek mentioned, the economic exposure allowed us to bring in additional information about which sectors may be hit harder going forward, and we want to understand how that could affect portfolios. Now, although we only shocked a handful of countries, country industry factors, the propagation picked up on knock-on effects on other sectors that make sense economically. For example, semiconductor sector sold off more steeply across countries through their link to the US computer electronics industry, which was part of our assumptions. And on the other hand, more domestically oriented sectors such as utilities and telecommunication stocks were more resilient in our scenario, again brought forward by the correlations in our factor model. Another outcome of the analysis is that more cyclical sectors like the US automobile industry sold off more steeply beyond what was implied by country and industry assumptions. The nature of our scenario, one of slowing demand, could hurt cyclical sectors more, an effect that was picked up by the style factors in the factor model.
Could you expand on how style factor exposures amplify or offset the market and industry shocks?
Of course. So back to the example of the US auto industry, when you look at the decomposition of which factors drove the P&L under our scenario, we see 3 main categories. First, there is the broad US equity market, which sells off, and that pushes down the US auto industry. Second, the US auto industry factor itself was shocked in our scenario due to the tariff impact and the economic exposure analysis, and this compounds the market-driven loss, the broad market-driven loss further. But third, style factors, and in particular the beta factor, which captures the cyclicality of the sector, magnified the losses even further. So you can very nicely see in this decomposition how each of these 3 effects compounds the losses and leads to a sharp sell-off in the automobile sector in the US. And then there are other industries like US REITs, which are more defensive in nature, as shown by their negative exposure to the beta factor. And for those sectors, the beta contribution to P&L was positive, meaning it offsets the broad market-driven losses. So again, this decomposition of losses into fundamental factors helps understand how the few assumptions that we have propagate to various segments of the equity market.
Finally, Thomas, what are the broader lessons for investors when it comes to using stress testing and economic exposure data to navigate significant stress events?
Well, I have a couple of observations from talking to investors on, about scenario analysis and how to make sense of what's happening. So first, I think one of the key benefits of scenario analysis is that it is about storytelling. So it makes communication of risk to non-quantitative stakeholders easier because everyone can relate to stories like for example, the tariff narrative. And in my view, a good scenario analysis always starts with a good story. The second point is that going through the process of defining a scenario adds a lot of value. And I would even dare to say that the process is almost more important than the final P&L number. Because the process forces you to express the narrative in a quantitative way. You have to formulate assumptions which need to be supported by additional analysis. And that could be driven by the economic exposure data, by historical analysis, or by the use of our macrofinance model that translates economic views into market impacts. And then once you have the assumptions, propagating those to the portfolio also often leads to surprising insights. And these insights, they may make a lot of sense economically, like the examples described above, in which case That's a great insight. Sometimes they're surprising and they don't really make sense, and you need to further refine the scenario, in which case you're again kind of learning something about your portfolio, your exposures, and how the story could impact your portfolio. So the process is really adding a lot of value. And the third point is, of course, that scenario analysis allows to react quickly in changing environments. You can incorporate evolving views, and you can take a forward-looking perspective on how stories may play out and affect portfolios. And we've seen this happen over and over again. I mean, during COVID, um, during the surging inflation in 2022, and the start of the war between Russia and Ukraine. Um, and now I think is again a time when scenario analysis can really help to make sense of the new developments that are almost happening on a daily basis.
Well, Abhishek and Thomas, thank you both so much for joining us for this timely discussion on stress testing in light of the tariffs. Really great to have you with us. And thank you to everyone out there watching. Once again, that was Abhishek Gupta, Executive Director of Equity Investing Research, and Thomas Verbraken, Executive Director of Analytics Research at MSCI. And I'm your host, Jenna Dagenhart with Asset TV.